Hey everyone, welcome to another edition of our Smart Investing Weekly Stock Analysis. Where again we take a closer look at those companies that are making big news or having big movements in the stock market. And as always, if you find the video informative, be sure to hit that subscribe button so you're aware of our future videos as well. But today's topic, we're going to take a closer look at the company Roku. And Roku, just another one of those darling stocks that, gosh, was just going up and people were making tons of money off of it. It was fantastic. And now the tide has turned a little bit, actually a whole lot of it. And it's kind of joined the ranks where we've seen it with Zoom, we've seen it now with Roblox, and now Roku, a huge miss today, down more than 22% just today alone. Kind of what happened with the stock? Well, yesterday they reported earnings. Earnings came in, well, I'm going to say earnings came in good because they were 17 cents per share. That's an adjusted basis. That beat the expectation of 9 cents. So how could the stock be down 22%? Well, you start to look at the revenue. Revenue was 865 million. The expectation was 894 million. And what you're starting to see now is you're starting to see decelerating growth. That doesn't mean you're having a decline in growth, but it's slowing down. Say that because revenue grew by 33% year over year. That compares with 51% in the third quarter and then 81% in the second quarter. So when you have these high growth type companies, people like to see growth accelerating, not decelerating, as now you're seeing with Roku. And especially when companies trade at these high lofty valuations, and we'll kind of get into those valuations here shortly, you have to see earnings beats, sales beats, raising of the guidance that beats those expectations, because these stocks are priced for perfection. And again, the guidance here for Roku, I'm going to say, was a pretty big miss. As Roku said, they're looking for $720 million in the first quarter. The estimate was for a revenue of $748.5 million. So, this is the thing that we try and avoid here at our firm. And when we invest money, is we don't like to take these high risks when you're buying businesses like this, because you can ride the wave for a while and, as I said, make tons of money, but all of a sudden, as you saw, the bottom can just fall out. And I do want to warn people, Roku now is down about 77% from its high. Don't think that, well, it can't go any lower. And what I'm going to say is stock could be down 90% from its highs. We saw this during the tech boom and bust where, prominent names all of a sudden just, they fell apart. If a stock goes from being down 80% to then being down 90%, if you buy when it's down 80%, well, actually, you've now had a decline of 50% if it goes from an 80% fall to a 90% fall. Just kind of make that simple. Let's take a closer look at it. If you bought a stock at 100, let's say, it goes down 80%. Now you're at a $20 stock. But all of a sudden you say, well, there's no way it goes lower. It's already down 80%. Well, if it goes from 20 to $10 a share, well, now you're down 90% on that from the $100. But if you bought at 20, now you're still down 50%. So don't just think because the stock falls this much that there's not much downside potential, much downside risk any longer, and it can only go up. This is how people got burned a lot in the tech boom, was buying those companies that were falling and falling drastically. Never want to catch a falling knife there, as they always say. But let's take a closer look here at the numbers for Roku. And again, a reason why we still don't like businesses like this. They're still not what I'm going to call good values. And we'll take a closer look at the numbers here. I'll kind of explain it in more detail. But let's take a look here first. You see the industry. They are in the entertainment industry. And I got to say, I have, 3, 4 Rokus in my house. I love the product. I think it's a phenomenal product to use. But just because, as we always say, just because it's a good product doesn't necessarily mean it's a good investment. Very different type analysis. I love going to the store, buying the Roku. It doesn't mean I want to go buy the stock. Well, first we can see here the short percentage of float. There is a decent amount short here, 5% we'll round up. Institutional ownership, 71.6%. We will be seeing more data here coming out. As you can see, the last full report date was for September 30th. We'll get new numbers here shortly for the December 30th ending period. Still is not going to have a huge impact on their valuations, though. You can see the price to earnings multiple, even after this drastic fall, 54 times. Again, this company is not inexpensive by any means. See price to sales, 6.1. That's above the industry average of 2.6. See price to book value at 5.6, also above the industry average of 3.2. Price to cash flow comes in at 51.8, well above the industry average of 16. You can see because of the growth, there is a nice PEG ratio, and PE divided by growth is what PEG stands for. Gives you a good proxy of what you're paying for that earnings growth. See 2.8 above the industry average, 2.6. See no earnings growth here over the last 5 years. Sales over the last 1 year up 43.3%. You see going forward, analysts are still expecting good growth at 50.7%. I wouldn't be surprised to perhaps see that pull back after the most recent earnings report. Not surprised here, no dividend for the company. I do see a negative buyback yield. That means they've been issuing stock instead of buying back stock. We don't like to see that because then it's diluting the current shareholders. We like to see our companies buying back shares as it increases their ownership in the business, not again dilute it. Looking at the balance sheet, that is very strong for Roku. You see the current ratio here, 4.4, plenty of liquidity, almost too much liquidity. I don't know why they have this much available. I'd like to see them maybe deploy that in investments or have something where they can continue to have growth. I don't think the companies have this much in cash or liquid investments on their balance sheet. Debt to equity stands at 20%. That's very strong. Not much debt on the balance sheet at all. I'm not worried about them folding tomorrow by any means. It's just kind of more of a valuation story rather than a poor company story. I see days inventory here, 22.8. That is above the industry at 6.9. I like to see that lower. Day sales outstanding, 85.1. Also above the industry at 47. I'd like to see them collect on the receivables at a little bit higher rate. See a net profit margin, 11.2%, slightly above the industry average, 10.8. That is a positive. Return on equity, 10.7, slightly below the industry of 10.9. And return on investable capital at 9, above the industry at 8.6. Now, here's what I was talking about earlier. You can see the current price here, $112.46, 52-week high. And it just kind of puts it in perspective, $490.76. What a fall that we have now seen. That's that 77% decline I was discussing. And you see today, the 52-week low has been put in place after the major fall. So year to date, stock's down 50.7%. So again, massive, massive decline for the stock. It is still a decent sized company with a $15 billion market cap though. Now, if we look over here, we always want to look forward when we're looking at what we're paying for the future earnings of a business. You can see December 2023, we're going to go about a year and a half is what we'll do. Excuse me, year and a half, 2 years, what we look at. Estimated earnings per share of $1.55. That would still give us a target sell price of just $25.73. And again, it trades at 72 times those future earnings. Very, very expensive. And see down the road, the earnings start to pick up, but you can see over here, there's less and less analysts, so the number's not quite as strong. And I do want to point out, just because I'm not liking Roku at this time, it doesn't mean I'll never like Roku. If the stock continues to fall and those earnings do come up, there could be a great opportunity to get into Roku stock. There's plenty of examples where companies become way overpriced, they have major corrections, present great buying opportunities, and it could happen in a Roku type name. I just still think it's too overpriced and still doesn't fit that value investing philosophy. And I think value is going to have a much stronger year this year than a lot of the growth companies out there. And we've kind of seen that start off the way my prediction has kind of been anticipated. But with that, I hope you find the video helpful here today. If you did find it informational, be sure to visit our website, smartinvesting2000.com. Again, that's smartinvesting2000.com, and find out more about our firm. And also, too, if you enjoyed the video, be sure to hit that subscribe button. Just as a reminder, this video is for informational purposes only and should not be used as investment advice. We'll see you here again next week.